Let's now do illustration number 13. CBA Limited issues convertible debentures to RQP Limited for a subscription amount of rupees 100 crores. The debentures are convertible after 5 years into equity shares of CBA Limited using a predetermined formula. The formula is 100 crores multiplied by 1 plus 10 percentage whole power 5, the whole divided by fair value on the date of conversion. Alright, so what it is actually saying is it's going to get converted into 100 multiplied by 1.10 whole power 5 divided by fair value on the date of conversion. Alright, so whatever is the fair value on the date of conversion of the equity share, whatever is the fair value of the equity share on the date of conversion, depending on that, we are going to calculate the number of equity shares, and accordingly we will issue the equity shares. Alright, CBA Limited will issue the equity shares based on this formula. Why are we actually multiplying this by 1.10 whole power 5? One way of looking at it is 10% is basically the interest rate for each year. All right, we are not paying interest every year. Instead, what we are doing is we are saying that the interest will keep getting added to the principal amount. The principal amount was rupees 100 crores. We will keep accumulating interest as at the rate of 10% for the next 5 years. And whatever is the cumulative principal plus interest, that will get redeemed by issuing equivalent number amount of equity shares. All right, so let us say in this case, if the fair value increases, then the number of shares will decrease. If the fair value decreases, the number of equity shares will actually increase. The question is, examine the nature of financial instrument. All right, clearly over here the entity has an obligation to issue a variable number of equity shares. All right, if the fair value increases, the number of equity shares that an entity will issue will actually decrease. If the fair value decreases, the number of equity shares will increase. All right, whatever be the fair value, the holders will ultimately receive 100 multiplied by 1.10 whole power 5. Let me actually calculate what is 100 multiplied by 1.10 whole power 5. It is 161.05 crores. All right. So whatever be the fair value of the equity share on the date of conversion, the holders of this convertible debentures will actually receive 161.05 crores of worth equity shares. They will receive 161.05 crores worth of equity shares. So they are not exposed to the performance of the company over the next 5 years. All right. Over the next 5 years, they're not going to be exposed to the performance of the company. And therefore, I cannot classify the 100 crores that I've received as financial. I cannot classify it as equity, but instead I will classify it as a financial liability because I have an obligation to deliver variable number of equity shares in future. All right. So, and the other way of looking at it is I'm using my equity shares as a currency. All right. I'm using my equity shares as a currency. The higher the fair value, the lesser the number of notes that I've issued, that I have to issue. All right. If the fair value of the equity share is higher, I need to issue lesser number of notes. If the fair value is lower, I need to actually issue more number of notes. So I'm actually using my equity shares as a currency, and an obligation to issue currency is basically a liability. All right. Therefore, I'm going to classify this as a financial liability today. After 5 years, when I issue equity shares, the liability will get derecognized and I will record equity on that date. But today, I will be recording this as a financial liability for 100 crores. All right. The journal entry for this will be bank account debit 100 crores to financial liability 100 crores. I will be recording it as a financial liability for 100 crores. So that is with regards to illustration number 13.